Hi, welcome to today's Tuesday Tweak. I'm Deb Pervin, and today our Tuesday Tweak is about asking your bank for a loan. Do you need a revolver or a term note? So let's talk about the difference because you don't want to walk into a bank and sound like you don't know what you're talking about when you're asking for a loan. So let's distinguish between these two and make sure you ask for the right type of loan. A revolver, a revolving line of credit, is for working capital. This is a line of credit is an amount that you can borrow up and down. It's typically interest only, and it's to bridge the gap between providing a service and paying all your employees and receiving the payment for that service, or building a product and the cost of raw materials and labor, selling the product, and finally getting your cash. So it's for working capital. It's for short-term needs, and that's why it's interest only, because the expectation is the loan gets drawn up and paid back on a regular basis. Now, it's like a credit card, only it's a lot less expensive, and it will be secured by the assets of your company, and the bank may ask you for a guarantee. All of these are very standard, but it's a great place to start a banking relationship because it's not a very complicated transaction, and many banks will just monitor it on an annual or quarterly basis, so you have a lot of flexibility in how you use it. The second kind of loan is a term loan. This is like a loan that you would have on your house. You start with one amount, and then you pay principal and interest every single month, and it reduces the loan over the term. So if you're buying a piece of equipment, you might have a 3 or 5 year term if it's a big machine for your plant. Usually the term matches the life of the equipment. So if you're buying a warehouse, you might have a 20 or 30 year amortization. If you're buying a computer, you're probably only going to have a 1 year or a 2 year amortization if it's a big IT system. So the life of the product is important, and you'll be paying it down over time. You cannot borrow up. But this creates positive cash flow because instead of spending $100,000 for a fancy piece of equipment you use, you could spend $3,000 a month over the next 3 years. That makes it a lot more digestible and a lot more practical for running your company. This is good leverage. So finally, your bank is going to want to know that you can make these payments. So they're going to look at debt service coverage ratios and leverage ratios. That will be the subject of another Tuesday Tweak and is covered in great detail in our Know Your Numbers Financial Boot Camp. So if you want more information, check that out. Tell us if this helped you or if you have questions about our Tuesday Tweak, and I look forward to seeing you next week. Bye-bye.